Hi everyone, welcome to the Contra Turtle Show. I'm a 38-year-old Singaporean 9 to 5 worker, and on this channel, I reveal YouTube's most transparent stock portfolio and my journey towards 4.5 million Sing dollars over the next 12 years. In the last two episodes, you guys left me 450 comments after over 40,000 views, and I read and answered every single one of them. A lot of the comments asked about USD depreciation risks and how that might affect US investments as a Singaporean investor. Now, I take your feedback very seriously, so don't forget to like this video and leave your comments and questions below. In today's episode, I'm going to share 4 overlooked points comparing Singapore versus US stocks when growing your retirement portfolio. So, a quick update the portfolio value is currently at 437,000 Sing dollars, of which 272k is invested capital and 164k are the gains so far. So this 272k capital is money that I actually saved over several years. I'm already 38 years old. In fact, I would say that I'm quite a late bloomer. But I saved this amount of money over many years. A lot of my income, bonuses, etc., channeled into the fund. I live in a very simple BTO HDB flat. I don't own a car, and I don't inflate my lifestyle as my income grew over the years. And I'm very fortunate because my spouse, my wife, she has the same philosophy. So she's very simple and she's very frugal. So this was, really a lot of credit to her for also supporting me in this long-term endeavor. So if I invested in the S&P instead, I would have only grown the fund to 306k instead of 437k. So that's about a 131k difference in profits over the last few years, beating the market. If I switch over to the performance tab, on an annualized basis, this is time-weighted returns. Over the last 4 years-ish, since I started, 4 years plus, the portfolio has returned 16.95% compared to the QQQ at 8%, which is half of my returns, and the S&P, which is about 7.22%. And this is despite the current bearish market. So I'm giving you this update as of today is the 19th of April. And so I'm pretty happy with the performance. But to be honest, it's only been about 4 years plus. This, in my opinion, is still short term. So we shall see what happens in a 12 years' time. So this is like over a 16-year period, right? 12 plus 4, the last 4-5 years I've been investing, where I reach my target age of retirement at 50 years old. Then I look back and I see, okay, how well have I truly performed over the long-term horizon? Next, if I just look at the allocation, the portfolio has only 5 companies, modeling the styles of Charlie Munger, which I think some of you know, Dave Cantasaria, Nick Sleep. These are investors that I really look up to and I studied their philosophy. So I actually like their style. I focus on only a select few businesses within my circle of competence, which is mostly in tech. That is the field that I currently work in as a 9 to 5 employee. Now, I know what you're thinking. This guy, Xiao, got 5 companies only. Where's the diversification, Xia? So I won't cover portfolio management or my selection criteria today. You can check out my older video in the top right corner. There should be a banner appearing now. But yeah, if you're interested, the 3 investors that I mentioned, I'm quite aligned in their very focused and concentrated portfolio philosophy. So you can also go read up about how they handle it, some of their fund letters that they release. They're all free. And obviously, Munger, you can just look at his past filings under his fund. So let's get started on today's episode, which is Singapore versus the US stocks. So in the last video, I was asked, if I invest in US stocks, won't I kena USD currency depreciation over time? The US Fed keeps printing money and the USD keeps weakening because of that. Shouldn't I just invest in Singapore SGD stocks so that I can shield myself from the weakening USD so that I don't loogie? So let's use first principles to see if this theory actually makes sense. Now remember that when we talk about the strength of a currency, we must always talk about it in currency pairs. Since we are looking at it as a Singaporean investor's perspective, let's take a look from a USD versus SGD perspective. So here we have a graph of the USD versus SGD over the last 23 years. We can see it is indeed true. The USD has in fact depreciated by a whopping 27% since 2002 over the last 23 years. So that means every $100 you've invested into the US market, if you started 23 years ago and just left it alone, just by currency depreciation, you have lost $27 out of 100 Sing dollars in Singapore dollar terms, right, over the last 23 years. So that sounds terrible, huh? But what happens if we superimpose the S&P 500 onto this same chart? Over the same period since the early 2000s, although the USD fell by 27% as I just mentioned compared to the SGD, the S&P 500 actually rose by 391%, far outweighing the loss in currency strength of the USD versus the SGD. Now, this rise even includes the lost decade in the USA between 2000 and 2009. So the 27% decline over time does feel quite sian. It's like that friend, who keeps asking you to belanja him a few dollars every time, to buy him a meal or to sponsor him a labubu. I mean, you're still earning more cash at your job lah, but this mosquito friend keeps sucking a bit of your money every time he meets you, just sucking the money. So over the long-term horizon, in the grand scheme of things, you're still doing okay. But these mosquito bites are just a bit irritating lah. So we've only looked at the currency implications for the US market. But what happens if we now compare it to the Singapore stock market? Hey guys, before I move on to the Singapore market, can you guys please hit the subscribe and like button and give me some turtle power or not? My last viral video had 40,000 views but only 1,000 likes. What the hell happened to the other 39,000 people? Come on guys, can I get some W's in the chat and some support for the local Singaporean turtle or not? Thanks guys. So speaking about the Singapore market, one of the most common sayings we hear is, Singapore stocks give good dividend yield income, so the investment must be better and more safe. The US stocks give less dividends, or they don't even give dividends at all. It's not very good, not very safe, quite risky. Now there's a few parts to unpack with this statement. So let's tackle the first concept, which is total returns. Now total returns basically considers adding together both the capital gains, which is how much the share price increased, as well as the dividends distributed by the stock you own, to measure that overall return on your money that you invest. If we take a look at the STI index, for example, over the last 15 years, the average dividend yield is somewhere around 3 to 4% per annum. And the share price or the capital gains of the index for the same period has been about 19% over these 15 years, which is the darker blue line at the bottom of this chart. And so the total returns, which is actually represented by the dashed blue lines above, was actually 93% for this period when we combine the impact of both the dividends and the capital gains. So this gap is actually supported by dividends as opposed to the actual growth of the share price in terms of capital gains, which isn't up by a lot despite such a long time of 15 years. Next, if we look at the S&P 500 in comparison, now it only pays a very weak dividend yield of 0.5 to 1% per annum. And don't forget, there's a 30% dividend tax that Singaporeans need to pay on US stocks for the dividends. So the effective dividend yield actually works out to be only 0.35 to 0.7%, which is very small compared to the STI's 3 to 4%. However, the capital gains for the same period, which is the increase in share price of the S&P 500, has grown by plus 382% over this 15-year period. And this is even before adding the dividends, which would result in a total return of 535% or 489% after we conservatively deduct 30% dividends tax over this period. And so this far outweighs the 93% total return that I just mentioned in the earlier slide of the STI, even though the dividend yield of the Straits Times Index is at least 6 times that of the S&P. Now that I've demonstrated the difference in total returns, does it simply mean that the US market is just better than Singapore stocks? No, that's not the learning lesson here, guys. The main point I'm trying to say is don't judge based on dividend yields alone. Take a step back, look at the bigger picture of total returns so you don't miss the forest for the trees. And then once you have the total returns in mind for comparison, then assess the risk factors. For example, the volatility of the US versus the Singapore stock market. Yes, the US stocks do give higher total return on average, but are you really okay to take that volatility in exchange for that higher total return? Or are you the kind of person that cannot sleep at night when your stocks fall 30 to 40%? Now, I know many people like that. You know yourself best. Don't lie to yourself, guys. Remember that you might think that you have the temperament to handle volatility, but like Mike Tyson always says, everyone has a plan until they gonna punch in the face. The easiest way is to ask yourself, how do you feel right now in this current Trump tariff bearish market? Are you fearful? Are you stressed? Or are you actually damn bloody happy because the prices of all the shares are so beaten down now? Let me ask you another question. How did you feel a few years ago in 2022 when the Fed increased interest rates very suddenly and crashed the market? Were you crazily buying equities as they crashed? Or were you instead loading up more money into your UOB1 account to earn the high fixed interest rates or putting more money into SSBs? Because at that time, all these high yielding fixed interest instruments looked enticing at that moment. But a true contrarian would have bought beaten down equities at that time, despite all the fear that the Fed was creating and all the uncertainty. Because a true contrarian and someone who really has the temperament in the beaten down market understands that over the long term, the recovery of the beaten down stocks would far outweigh whatever fixed interest rate returns you gain in that 1 to 2 years parking your money in UOB1 account or SSBs. These are some of the quick tests you can ask yourself whether you are more suited for income investing with local stocks via dividends or the more volatile but higher total return of US stocks. And then next, consider some of the tax implications once you have all this context in your mind, such as the 40% estate tax on US stocks, which is how much, this one damn morbid, how much you got to pay the US government if you die and your family inherits the money, right? So it's like 40% is a huge amount. And of course, the 30% dividend tax that I just mentioned earlier on. Are you still willing to invest in the US market in spite of these taxations? And finally, the important thing, which is your circle of competence. Are you familiar with US businesses compared to local businesses? Of course, if you buy the index, it's a different story, right? For example, the S&P 500. But if you do stock selection, then the question is, are you more familiar with the financials of, say, a local company like DBS versus, say, Meta in the USA? Do you understand the business models? Or do you understand, the management, their track record, their products, how their advertising model actually works? So for my case, I decided on investing in the US tech stocks because I work in a North American tech company and I understand that the US tech businesses, in terms of how they function, very well down to a granular level because of my work. So it falls very nicely within my circle of competence. And in addition to that, I have a lot of passion and I read up a lot of newsletters. I watch a lot of YouTube from the US market YouTubers. And I read a lot of books about the US market and also the technology and the product scene. For example, with the current AI trend, I actually understand how the LLM works, right? What next token prediction means, etc. So this is just a sample and a flavor of circle of competence, and you really have to understand the businesses that you invest in, especially if you're doing stock selection. With all that said and done, it almost sounds like, wow, you're very biased towards US stocks, contra turtle. But the fact is, in the last two videos, one of the viewers, his name is Kevin Ho. Sorry, I'm not going to dox you. This is the actual name that you put in your YouTube. But Kevin wrote in his comment, and he talked about how he started investing in local DBS stocks some 15 years ago by slowly adding his salary and bonus and continuously reinvesting dividends. Today, 15 years later, he has a monthly dividend of 25k Sing per month from his shares, his DBS shares, and is now enjoying his retirement and is working because he wants to, not because he has to. And this example here goes to show even with local stocks, despite a lower total return, you can still achieve what you want that fits your risk appetite by staying long-term invested within businesses you understand, reinvesting your dividends, delaying gratification, and avoid buying labubus or over-leveraging yourself into luxury cars, luxury goods, or condos that you simply cannot afford just because you want to save face, look rich to your friends, relatives, and peers, but you're not actually rich. So there's fake rich and there's real rich. What do you want to be? Now, this example here, in my opinion, from Kevin, is true financial freedom, where you choose to work if you want to work, and you're free to enjoy your passions as you deem fit. Now, 25k per month means his fund is really quite sizable. Now, we don't all have to aim for the same final retirement target. Every one of us has a different angle, income level, and we know roughly, what kind of consumption we're going to have at retirement, what kind of target we want at retirement. So, for example, for myself, if you guys have seen my earlier video, I am targeting a rate of 15k, which is less than Kevin, and I'm targeting it in 12 years' time. So, I've already been investing in the markets for the last 4 to 5 years as of today. You can look at my earlier video where I talk about some detail about this. So really customize it to what sort of lifestyle you want to have at retirement and at what target age. It doesn't have to be 50, it can be longer, it can be later, it's up to you. Then work backwards, figure out what is the sort of contribution you need to invest in per year and the sort of minimum hurdle CAGR rate you need to achieve as a minimum to get the retirement amount you're looking for. And start taking action now, guys. Stick to your plan for the long term and start taking action now. So I hope you enjoyed this episode, everybody. I also want to share that I'm actually having a kid soon. So my wife is going to give birth anytime these few days. So I might not be around to upload a new video for a while. I already have some ideas of what I'm going to release in the next episode. It's going to be quite controversial. And every episode, I'm going to bring out the controversy or the contrarian stuff one notch higher. So if you're interested, remember to click like, subscribe, and stay tuned. Thanks everyone, and I hope you have a great long Easter weekend.